Hello, everybody. Welcome back. For those of you who are new to us, my name is Jerome Franks. I'm the president of CFA Society of the Bahamas. Thank you all for joining us again today as we continue our financial literacy series. Today, we'll be discussing the topic, investing fundamentals, how to invest in yourself and build wealth. Like last week, today's topic is very timely and I think also very relevant. Recently, the topic of investing in stocks, investing in cryptocurrencies, among other financial instruments have been pretty much a hot topic. I think more and more people are trying to get into investing and understand how to build wealth using that avenue. So I think today's discussion will be very informative to help you understand, like we said, the fundamentals, understand the basics of investments, and help you to, I think, make proper financial decisions when it comes to your retirement and building out your portfolio. If there's something in particular that you have a question about that's not addressed in the presentation, feel free to ask a question at the end of the presentation. You can send your question directly to the host using the chat feature in Zoom, or you can raise your hand and you can ask David your question directly, and he'll answer it, I guess, to the best of his ability. So without further ado, I'll introduce our organization and our speaker for today. For those of you who are new to CFA Society, we are an organization of financial and investment professionals whom generally hold or are pursuing the Chartered Financial Analyst or CFA charter. Our members are among the top financial and investment professionals within the country and within the world. For more information on the society or the CFA designation, please feel free to visit our website, cfasociety.org/Bahamas. So our speaker for today is David Slatter. He will be discussing the topic, like I said, investing fundamentals, how to invest in yourself and build wealth. David is the Vice President of Investments at RF Bank and Trust Bahamas Limited, formerly Royal Fidelity. With over 20 years of experience in bringing wealth management services to the Bahamian people, David Slatter is experienced in wealth creation and managing risk. He holds a Master of Economics degree and a Master of Business Administration degree from York University, and is a Chartered Financial Analyst charter holder. Mr. Slatter has a penchant for connecting clients with products and services that suit their needs and secure their future. Ladies and gentlemen, let's welcome David Slatter. And David, I'll hand it over to you.
Well, thank you, Jerome, and thank you to the CFA Society of the Bahamas for inviting me to speak tonight. I always enjoy the opportunity to, to share some of the knowledge I have, but also to gain some of the insights and what should I say, learn about the issues that are important to members of the society, but also people who attend your seminars, and in this case, your Zoom calls. So I'm gonna let you know, we've only got 20 slides and I'm gonna go through them, not slowly, but we'll take our time, and it should leave a lot of time for questions, Q&A. So please make a note of any questions. Remember, there's no bad questions. All questions are good. And almost always, if you have the question, somebody else has the same question. If you ask it, you had the courage to ask it, they didn't. So don't be shy. So here's a quote from Sir Winston Churchill, because it all comes down to planning. His quote was, "He who fails to plan is planning to fail." As the individual who led Britain during the World War II in their effort against the Germans, the Nazi Party, and succeeding, I think he understood how to plan, that's for sure. So let's talk about some of the questions that that relate to investors, and that you as an investor, or if you're an investment manager, you need to ask. And some of those questions are, how much do you actually know about investing and investing products? So it's important that you either have knowledge or you have access to somebody with the knowledge with respect to investing products, investing strategies, understanding risk, risk versus reward, and either you've taken the time to gain the knowledge yourself, or you have access to somebody with it. Another question you need to ask is, are you a risk taker or are you risk averse? Because you may have the ability to take risk, but you may not have the willingness to take risk, and vice versa. How much risk can I take is another question. So depending on what you're saving for, what you're investing for, you need to understand the risks, because if it's essential that you have this this money at the time when you need it, you need to understand how much risk you can and can't take. So something to bear in mind. And what are my investment objectives? So what are you investing for? What are you saving for? Usually when people save, it's for a short-term objective. I'm saving for a down payment on a home. I'm saving for a vacation. Investing is usually longer term, and the rates of return are usually very much lower on saving, hopefully higher on investing. What are my investment objectives? I just mentioned that. And then also, how much can I invest on a monthly basis? So I don't actually have a slide on budgeting, but budgeting is essential, because the better you budget, the more cash you have at the end of each pay cycle, which means the more you have to invest, and therefore the larger the nest egg you'll have at the end of your career. Some other things that, basics that investors need to know. And I mean, even those of us, who are in the industry and have a lot of experience, it's always good to remind yourself that, for example, risk and expected return go hand in hand. So unless you can actually quantify the risk of an investment, you're not able to determine whether the return is sufficient. So in other words, if you don't understand what you're investing in, then you can't assess the risk, and the return may sound phenomenal, but it may not be sufficient. The power of time and compounding, really the key tools to wealth creation. And I'll show you a little later, just some, basic slides, but showing you the impact over time of compounding, and also earning a slightly higher rate of return. As I just mentioned, you do not invest in something that you do not understand. So initially keep it simple, and as you gain knowledge, then you can broaden your investment horizons to include things that are maybe a little more complex and have a higher expected return potential. But once again, if you don't understand it, leave it alone. And diversification is the key. All right. So for example, in the local stock market right now, like we have an equity fund, and it's actually up over 4% year to date. But if you were to look at the individual securities, you would find some have lost 20% in 3 months, and some have gained 20 to 30%. Actually, some have gained more than that in the short term. So if we were just picking an individual stock, we may have got it wrong. But through diversification, you reduce your overall risk. And therefore, that risk return profile that I talked about in the first bullet point is hopefully as close to optimal as possible. The investor life cycle. So it's, gives you an idea that, initially when you're a student, you're consuming, you're spending money, you're not saving. And then when you become employed, and hopefully over time your salary goes up, and you get promoted, the amount you save can increase. But there does come a time where, unless you've done a really good job at saving and you're generating sufficient income to meet your consumption needs, you start to eat into your actual savings. And that's in retirement, we call that, say, the dis-saving phase. So something to bear in mind, the more you earn, the greater your potential to save. All else equal, the higher your educational attainment, the greater your earnings. And more saving and investing means a more comfortable retirement, and even possible intergenerational wealth can be created, and you can pass it on to your children and even grandchildren. So here's just, we talked about the importance of human capital, the importance of investing in yourself. And the higher your income, the more you can save, obviously the easier to meet your investment objectives. This is from 2017, the US Bureau of Labor Statistics. And it shows you, if your educational attainment was a doctoral degree, professional degree, master's degree, bachelor's degree, associate degree, high school diploma, or less than a high school diploma, what your median weekly earnings would be. And you can see it goes up quite materially as you improve your educational attainment. And you see, if you have a professional degree, you actually earn more than somebody with a doctoral degree. I found that a little surprising, but what would be kind of interesting if you had the two of them, then what your salary would be. But what I want you to bear in mind is that, it's important to continue to educate yourself, to expand your knowledge base, even through your entire career. It really doesn't end, okay? So at the end of the day, what's the conclusion? If you don't have it, get your CFA charter. I think Jerome would fully agree with that. Let's talk about risk-free and, a risk-free investment decision. Quite often you hear about, AAA rated government debt is considered risk-free. Canada is normally considered risk-free AAA. Actually, one of the rating agencies has a AA plus. The same for the US. This S&P 500 has a AA plus. But the rates of return on sovereign debt issued by, risk-free or AAA rated entities is incredibly low. Another way to think about a risk-free investment is if you have debt, the interest rate you're paying on that debt, every time you pay against the principal, you are saving that rate, and that's risk-free. That's truly a risk-free investment, right? Because at the end of the day, your net wealth is a function of assets and liabilities. And if you can reduce your liabilities and also reduce the interest expense on them, go for it. Pay off high interest rate debt first. Credit cards, get in the habit of paying them off in full at the end of each month. So take advantage of the perks they offer, but don't give the lenders the opportunity to earn 18% from your hard-earned pay. And don't worry about the date and the scale, but this is really just to make a point. So if you have a mortgage and you would add a little extra every month to your mortgage payment, in this case I threw $100 extra or $200 extra, you can reduce the life of the mortgage materially, because early in the mortgage cycle, most of your payment is going to interest and very little principal. But if you add a little extra, that reduces the principal, and you can knock off quite a few years in the total term of your mortgage. And needless to say, you'll save tens of thousands of dollars in interest expense that instead of giving the bank, you get to invest. So always, once again, this is like a risk-free rate of return, right? If your mortgage is 7%, every time you pay off the principal, you're reducing your interest expense by 7%. So bear that in mind. Standard investment plan for investors. So, most textbooks will talk about when you're young, you should be in equities because you can take on more risk. You've got more of your career ahead of you. You can recover from setbacks. And, for the most part, that's true. But you can also think about it that if someone is new to investing and they're convinced to go heavily into equities, and lo and behold, it turns out to be a really bad time to get into equities, and they lose 10, 20, 30% that year, many individuals are going to step back and never touch equities again, right? Once bitten, twice shy. So if that happens, you've in effect, what should I say, eliminated the ability of that person to benefit from equities over the rest of their career, or it may take a number of years for them to get the courage to get back into the market. So if you know the individual and they understand investing, they have a certain amount of knowledge and they're young and they can take on some risk and they're willing to take risk, then yes, maybe you go primarily into equities and they're younger. And as they get older, you reduce the equity position and go into more fixed income securities to provide more income and less risk. But you can also think about it from a different perspective. Initially going into something that's low risk and liquid. All right, so you kind of build this stable platform investment portfolio for the individual, and it gives them a chance to gain some knowledge on investing, but at the same time they're not exposed to really high risk. And this could be, quite often you hear it said that you should have about 6 months salary saved for emergencies, loss of employment and the like, or maybe there's an opportunity to move to another employer, but there is a period of time between when you're going to make that move and you need to have liquidity to meet your needs. So I've kind of flipped that initial model on its head and said initially go into some low risk liquid investments, then you can add some medium risk investments, then you can add high risk investments. And of course, just the idea, we don't want individuals to be startled or shocked or scared away from investing in equities due to a bad experience in the short term. And here's just an idea. Maybe, you instead of that pyramid, something where over time, maybe if somebody has an intermediate amount of experience, you kind of build something that's more even with each level. So a blend of, low risk, medium risk, and high risk. And what tends to happen over the medium to long term, because the rate of return is greater on the medium risk and high risk investments, just by virtue of capital appreciation and the accumulation and reinvestment of income, those layers are going to expand and actually become quite big, quite much larger than, say, the low risk and liquid investments. So it comes down to knowing the individual. If you are a investment advisor or a manager, understanding the investor's profile. And for somebody who's experienced, so this would be kind of your more traditional. You definitely have more of your investment in high risk investments, and then the smallest amount on the lower risk investments. And so it all comes down to what you think is best for yourself and or your client. Let's talk about, just give you an idea of the power of compounding. So if you invested $100 a month and you invested at 2%, 4%, 6%, and 8%, so the blue is 2, the orange is 4, the gray is 6, and the yellow is 8. Initially, in the first 5 years, yes, you can see that the 8% is slightly better than the 2, but it doesn't really jump out at you. But as you go in time, you go 20 years and 30 years, you see the power of compounding, you see the exponential growth that results, and you see a huge difference in the value of your investment, 150,000 at 8% versus 49,000 at 2%. So the power of compounding, sometimes you need a visual aid to really appreciate it. So this is just to give you some, what should I say, an appreciation for the power of time and compounding, and also the power of getting a little bit of extra return, right? So 4% versus 6% versus 8%. So 8%, you're thinking about equities, 4 to 6% more corporate debt, and 2 to 4%, you're thinking more, bank accounts and also government bonds. So something to bear in mind. The next slide is just $200, same story. So we don't need to go into that in detail. So this would be verse the 2, the additional accumulated wealth, right? By an extra $100 a month, we're talking about an extra $150,000 over 30 years at 8%. So earlier I talked about budgeting. If you can figure a way to get an extra $100, $200, $500,000, whatever the amount is, invested versus consuming or paying high interest on debt, then this is the kind of benefit you get over your career. So, and also bear in mind, when you retire, that's not the end of your investment life, right? I mean, most people are living, 20 years plus beyond retirement. It depends, women a little longer than men, but still 15 to 20 years beyond retirement that you still need to consider what kind of investment portfolio you want. And if you're fortunate enough to have enough wealth that you can think about leaving it for the next generation, then of course, really, you're looking not 20 years out, you're now looking at another generation, a couple generations out. So you definitely have a long-term time frame. And just to give you an idea where this excess return would come from. So, around 36,000 of it would come from your actual contributions, the extra 100, but almost the same amount would be just from investment and capital gains. So over that 30-year period. So you've in effect doubled, well, it just shows you the power of having time and compounding at your disposal. And this was at 4%, sorry, not 8%. So this is simply 4%. Government bond, 4%. This is the kind of upside you can realize by being patient and being consistent over time. So expected return versus risk. There's no point in taking more risk if you don't expect a higher rate of return. And these are just some local funds to give you an idea of an income fund, a balance fund, and an equity fund. And since inception, the annual rate of return, 4.7 on the fixed income, 6.8 on the balance, and almost 8.8 on the equity. So the slides I showed you before using 4 and 6 and 8%, are not pie in the sky in Bahamian dollar terms. These are actual returns that you can reasonably expect even just in the local market. So bear that in mind, but always risk and expected return positively correlated. So if somebody, an investment comes along and the promise is, 15% annual rate of return, you better really understand the risk, because there's a lot of risk. So if a local equity fund is getting 8.8%, it's considered high. 15% out here, so super high. I mean, for example, not too long ago, I remember hearing about this great 10% rate of return for a 2-year paper, and I said to myself, if they're paying me 10 and they need a rate of return on their capital, what the heck is being invested in? Well, fortunately, we did not invest. Unfortunately, that investment went belly up, and quite a few Bahamian investors got burned. One of the easy way for people to get into investments is simply through mutual funds when you're starting out. So why would somebody want to invest in a mutual fund? I mentioned diversification earlier. So most mutual funds already have a very sizable portfolio that you are now contributing to and benefiting from. So while you don't actually own the shares in that portfolio, you own units whose value is based on the underlying investments. So you get diversification immediately up front. You don't have the cost of building a portfolio. Liquidity. So you need to know, is it a closed-end fund? Then liquidity is totally dependent on selling on the secondary market. Examples of that locally would be the Bahamas Property Fund or Benchmark. But if you have an open-ended fund, they'll have regular redemption periods. Most are monthly, which means that during any given month, you can subscribe to the fund and also redeem from the fund. And the fund is required to buy the units back from you. So you do have good liquidity. And that's really important in the local market, because, the local equity market, depending on the securities you're looking at and also the size of the shareholding you're trying to sell, liquidity can be an issue. Professional management. So, the fund managers do the research for you. They make the investment decisions for you. They analyze new offerings that come to market and the like. So you have the benefit of professional management and affordability. So with a relatively small amount, you can gain access to portfolios, diverse portfolios of securities. And local entities also give investors access to international markets. Currently, there's a moratorium on investing externally due to the COVID-19 crisis and the central bank's prudent decision to make sure they protect our foreign reserve position. But when that moratorium is lifted, there are a number of opportunities for investors to invest externally as well, not just locally. Benefits of mutual funds, so capital gains. As security prices are purchased by the mutual funds, an increase in value, these increases, remain in the portfolio, and the income that's earned by the portfolio gets reinvested. So the idea of compounding also comes into play. Dividend payments. So as I mentioned just now, the dividends on stocks and interest on prefs and bonds flow back into the portfolio, and they become reinvested. Regulatory oversight. So you have the Securities Commission and BISICs, obviously auditors as well. So transparency, quarterly reporting, and annual reports. Hopefully higher returns. If you're not getting higher returns, then what's the point? But hopefully higher returns due to the professional investment management. Also access to private securities that sometimes the general public never sees. So they're private offerings, and quite often they have somewhat attractive interest rates. Recently, there was the Nassau Cruise Port, an 8% paper, if I remember correctly, that came to market. That was private. The BPL reduction rate bond should be coming to market hopefully next month. We expect that to be between 7.5% to 8%. So that's something to bear in mind. Quite often, the general public may or may not have access to such investments, but the mutual funds and professional investment managers do have access. And disciplined investment. So, each fund has an investment policy guideline that the investment manager has to follow. So it's not as if the investment manager has, carte blanche to just do whatever they want. They've got guidelines they have to follow. And those guidelines will be reviewed by, in particular, the auditors, but also other regulators as well, to ensure that the mutual fund manager is adhering to the policy guidelines. What are some of the risks of mutual funds? Credit risk. So I mean, the risk that any issuer of a bond or preference share can't make a scheduled payment. So, if you owned it directly or through the mutual fund, that credit risk exists. Interest rate risk. Until recently, this wasn't much of a concern for the Bahamas, other than the prime rate being lowered. But recently, I guess 2019, the government debt was being priced by the central bank. So every month, all of the government debt is priced by the central bank, and we do have some interest rate risk now. So for example, if you bought, longer term paper that had a fixed interest rate, say 2 or 3 years ago, you will have noticed that the price quoted by the central bank is actually below par. So there's been capital losses for some securities. On the other hand, there's been capital gains for a few. But interest rate risk is now a real risk to be considered locally, seeing that we actually have a yield curve now. Liquidity risk. So, it's not always easy to sell some securities, even for a mutual fund or a large investment portfolio. You may find that certain positions are difficult to actually liquidate. And market risk, price of securities increase or decrease in value, and the fund manager risk, right? It may turn out that the fund manager is either not being ethical or is actually not a very good investment manager and not generating the rates of return that would be expected. I feel like I went through this fairly quickly. That was the last slide. We're going to open it for questions. So hopefully this wasn't too simple or too complex, somewhere in the middle, but feel free to ask any questions at this point.
Thank you, David. We have one question so far.
Okay.
First question, for someone who is trying to aggressively pay off student loans, would you advise waiting to invest until the loans are paid off?
So that was it. Somebody who's got a student loan and they want to know whether they should pay it off first?
Before investing, yes.
All right. So, usually the answer would be yes. I guess it comes. Can you hear me? Can you hear me now? Can you hear me now?
Yes.
Okay. It depends on the rate of interest on the student loan. That's definitely a part of the equation. But remember now, if you've got interest on a loan, that's really a risk-free rate of return when you're paying it off, right? So that's something to bear in mind. Unless you have a fairly low risk investment that can earn a rate of return higher than the rate of interest on the student loan, one may be incentivized to allocate some of their income to the investment versus paying down the student loan earlier than would be the case. And that'd be the case for any debt, right? So if you've got a mortgage and you've been able to negotiate a very attractive rate of say 5%, but you're able to get a fairly low risk investment that's earning 6 or 7%, then you may want to delay the repayment, or may not want to accelerate the repayment of principal on the mortgage.
Okay. Next question. Is there any indications from the central bank when the moratorium for foreign lending will be lifted?
No, and it'll be directly connected with tourism. So when you see the tourism industry start to pick up and foreign reserves start flowing in, and we have a very clear idea of when the COVID-19 crisis will be over, then I would imagine we should get some more visibility on when we expect that to happen. But no, there's been no indication from the central bank on when that would occur. The faster we get vaccinated and the faster the US gets vaccinated, the faster tourism picks up and the sooner that moratorium's lifted. So that's pretty much, those are the variables that'll determine that.
Okay. Can you discuss cryptocurrency? What is it and your views on it as an investment vehicle?
Earlier in the presentation, I mentioned about if you don't truly understand something, you stay away from it. I don't truly understand cryptocurrency, I'll be honest. I understand the concept of, like in the Bitcoin, they've only issued so many coins, so they limited the supply and there's demand. So, simple economics, when you have a limited supply, but increase in demand, the price will go up. But you see some huge swings from day to day in the value of, say, Bitcoin. I mean, I'm trying to remember the name of it. There's, there are a couple products that have come to market that are kind of like a ETF of cryptocurrencies. So if one was to venture into that asset class, then maybe using something like the ETF of cryptocurrencies would be a way to get your feet wet. But I would not have it as a major asset class within my portfolio. I'd have it kind of as maybe something smaller, 5%. At this point, I don't fully understand exactly how the cryptocurrency value will pan out in the future. So I don't have any exposure to it, and none of our funds have any exposure to it. That said, it doesn't mean that we aren't looking at it, because it's the returns are somewhat mind-boggling. But we want to make sure that we have a better grasp of exactly how that market works before we actually invest any of our clients' money at this point.
Okay, another question. Can you go through the differences between an open-ended and closed-ended mutual funds? And also if you can give an examples of some of the funds that you've mentioned in your presentation.
Okay, so an open-ended fund means that, the ability for you to get in and out of that fund is open. A closed-end fund means that once you've invested in that fund, the fund itself will not be buying or does not have to buy back your units or your shares. Closed-end fund, you will have to sell them on the secondary market, just like the shares of a publicly traded company. So for example, the Bahamas Property Fund is a closed-ended fund. If you own shares of the Bahamas Property Fund, you have to find a buyer for your shares. The fund itself will not buy them back. Whereas the three funds I mentioned earlier, am I still sharing my screen? Yeah. So these would be open-ended funds. So every month one can redeem or subscribe into these funds. So the open means the ability to get in and out. The closed means the fund itself is closed. You cannot sell back to the fund. You have to find a buyer yourself. So greater liquidity risk for closed-end funds, something to bear in mind. Usually closed-end funds have a longer time frame. So, you're looking to invest and hold that for maybe 10 years. It's not meant to be a short-term investment vehicle. So I hope that explains the difference between the two. So.
Okay, another question for you, David. How are the local equities performing given the COVID-19 pandemic?
Okay. So on this slide, we see the RF targeted equity fund, and it did earn a positive rate of return in 2020. BISX was down as a whole, I think down over 6% year to date, but the fund was up. I don't have the figure in front of me, but the fund actually was up. And what you had to do during the crisis, and some of the things we shared with our clients was there will be some companies that will actually benefit from the crisis. There'll be some that'll be more stable, and some will definitely be negatively impacted. So it was pretty clear the banks, their loan loss provisions were going to go up. Their profitability would be negatively impacted. Their ability to pay dividends would be impacted. Whereas, say, Doctors Hospital, which was doing the majority of the testing, initially at over $200 per test. Obviously, the prices come down, but our expectation was that Doctors Hospital would actually benefit from the crisis due to the testing they were doing. And then you had insurance companies. We didn't think they were actually going to fare that poorly, because people will try to make sure they keep their policies, up to date. If you've been paying into a life insurance policy, or you have health insurance policy during a COVID-19 crisis, the last thing you want is to be without health care. So we thought they'd be kind of stable. And actually, not only that, I mean, on a Family Guardian, for example, their fourth quarter results were out, and I think it's the best year they've ever had, to be honest. Now, it was primarily because benefits that they paid out were like $4 million lower than the previous year. So you have to bear that in mind. Abaco Markets, AML Foods, used to be Abaco Markets. You know, the food stores, we expected them to do well. I mean, I know I personally was spending more in the food store than I normally did because you weren't doing other things. And it was almost like you felt you deserved a treat. You know, I can't go here, I can't go there. Well, I'm going to get that chocolate. I'm going to get this. I'm going to treat myself. So I ended up spending more in the food store than I did before. And I didn't think I was unusual. So we thought AML Foods would benefit, and they have. Bahamas first holdings came to market in the second, what I guess that would have been October or September of this year. And, you know, we crunched the numbers, and we thought, my goodness, people want to sell this stock at $1.70, $1.80 per share. So we're more than happy to oblige. And I think in total for my clients and the funds, we picked up 1.3 million shares in that price range, 168 to 180. And it's at 290 now. So I think we did a darn good job. That's why we've outperformed, say, BISX, because we did make a strong bet on Bahamas first. So whenever there's volatility and when there's uncertainty, there's no doubt there's additional risk, but there's also opportunities. So you need to know where to look and how to benefit from them. Sometimes it's all about, you know, minimizing the downside, right? So it's not just about having positive returns. Sometimes your objective is to minimize how much of a downside you have. So I hope that explains that.
Yes. Okay, another question for you. This is asking for your opinion. Do you believe that the U.S. index funds have been overvalued during all these high surges this year?
All right. So in the first quarter of this year, let's use the S&P 500 as our proxy for the U.S. markets. So it was up around 28% in 2019. It was down 20% in the first quarter. And actually, if you went through to the middle of March, it was down even more. Then it bounced back. And year to date, over in 2020, it was up over 16%. And it continues to go up. There's no doubt that the valuation multiples are rich based on historic numbers. So if you look at historic PEs and historic price to book and the like, the US equity market is pretty darn rich. That said, the amount of stimulus that's been flowing into the US economy and the amount of stimulus provided by the Fed is unprecedented, right? So I think, in my opinion, it's really an issue of how long till there is a correction to more normal levels. So it's more a matter of timing, but eventually, you know, there is a revision to the mean, multiples revert to the mean. So if you look at the long-term mean, for example, mean PE multiple for the S&P 500 is around 16 times earnings. It's trading, you know, 20 something times earnings. So whether it's 1 year, 2 year, 5 years, at some point, even 10 years, you will see the PE multiple in the US equity markets reverting back to the mean. Now that happens by virtue of and/or prices dropping or earnings increasing. And this is where it becomes complicated, right? All this stimulus, all the massive amount of savings that the US consumer has, what will corporate earnings do next year and the year after that? My view is that, you know, at some point there's a correction, there's no doubt about it. And I think it's probably, you know, I think it may be a little rich even today, you know, at current values. So I wouldn't be surprised if by the end of the year, you don't see, say, the S&P 500 more in the 3,900 range versus the 4,150 range. So I wouldn't be surprised if you don't see some kind of correction between here and the end of the year. But you're going to have earnings growing, you're going to have prices adjusting. And at some point we get back to valuation levels that we think are more sustainable in the long term. So.
Okay, another question for you. Are there any specific funds and or fund managers that you would recommend for first-time investors who cannot afford any high risk just yet?
I'm not at all biased. Well, of course, I'll recommend the RF funds. I'm the investment manager of those funds. So not only do I work for the company, but I actually manage the portfolios. So the prime income fund is really the go-to fund for somebody who's new to investing and or has a low tolerance for risk. There's no equities in that fund. All right, so you don't have the volatility of equities, but you don't have the expected return of equities either. But you can see, I mean, it's been averaging around 4.7% per year since inception, and that is after fees. So that is net to the investor, just for the record. These are not return. These are not gross returns. These are net returns to the investor. And that has monthly liquidity. So you have, it's an open-ended fund, market leading rate of return on a fixed income fund, just for the record. And actually during 2020, the assets under management of that fund grew materially as people who had excess cash in banks earning a negative real rate of return. So if you consider inflation, they were reallocating particularly into that fund. So not only did the assets grow, it's got a very sizable cash reserve that's built up. So very liquid. Now, we intend to deploy that cash in short order. We think that the BPL reduction rate bond that comes out, you know, we expect a rate around 7.5 to 8%, a term of I don't know, somewhere between 15 and 20 years probably. But the key benefit is that, and benefit for the investor in the bond, not the benefit for the consumer of BPL necessarily, as we're all going to have an additional fee tacked on to our bill that will be used to fund the interest payments and in time the principal payments on the BPL reduction rate bond. That's how it's going to be structured. One thing the BPL did last year, which the first time they've ever done it, no idea why it took them so long, but they actually hedge fuel costs. So when the price of oil was down in that $20 to $30 range, they took out hedges, I guess through futures, but they hedged the cost of oil, which is now around $65 a barrel. So it's doubled since they did that. Boom, there you've got very material savings on the cost of fuel that goes to the bottom line. And based on what I've heard on the radio speaking, when Dr. Moxie, the chairman, spoke, he mentioned, you know, some of that is going to reducing the cost of the bill for the consumer, and some of that is going to the bottom line of BPL, which is, you know, I think that's fair. It was their decision to hedge. So the prime income fund, that's the short answer.
Okay, another question, David. With the current economic state of global markets, which affects here in the Bahamas, what period of time do you recommend persons to wait before venturing into any type of investments during this time here in the Bahamas?
Well, I mean, if you're looking locally, I mean, you know, the key concern we had at the beginning of the crisis was our foreign reserves, right? We're worried that we're going to have this depletion of foreign reserves. And fortunately, the government has been able to go to the international market and borrow and to top up our foreign reserves. And we're still at a very healthy level. And my expectation is that the vaccination effort in the US, which is progressing, you know, at a very impressive rate, will allow for the main tourism resorts here and then smaller tourism resorts to feel more and more confident to bring US visitors in to our market. They represent 85 to 90% of our tourism market. So we need the US market to recover. The US consumer sitting on, I forget what it is, like $1.7 trillion of additional savings, you know, due to all of the stimulus that's been going on. So they've got a ton of money burning a hole in their pocket. They're ready to travel. We're close. We've always had the benefit of our geography, you know, 3-hour flight from New York or less, you know, 4 hours from Chicago, Dallas. So we have this benefit of geography. If we do our part to make sure that the Bahamas is still deemed to be a safe place to visit, I think that we should see a steady improvement in our tourism numbers. You know, we're having a little third wave right now. It is concerning. We need to make sure that we do our part as a country and bring that under control. A part of that is the vaccination effort. A part of that is, you know, the mitigation efforts. But I think we'll get through it. And I think the second half of 2021, you'll see a steady improvement in tourism numbers. 2022, I think is going to be I expect it to be our best year ever. That's my view. That 2020 is going to be 2022, possibly our best year ever in tourism is my expectation, barring some COVID-19 catastrophe. Improving tourism numbers, inflows of foreign reserves, more stability to the earnings of local companies, and also the companies that have and entities that have issued fixed income securities. So I actually feel somewhat good about the outlook for our local security markets going through 2022. The main industry that one would be concerned about would be the banking sector. They took big loan loss provisions, but guess what happens when the economy recovers? They write back much of that, not all of it, but much of it. So you suddenly see losses flipping to profits. So I think the main drawing on the local equity market, the banks will actually be one of the key drivers of capital appreciation in 2022. So maybe I'm too optimistic, but that's kind of my view. So, once again, if you're in it for the long term, if you're saying I need to invest for something at the end of 2021, then you need to go put your money in a bank or the prime income fund would be, safe. But I wouldn't venture into the equity markets over such a short time frame. But if you're looking, 5, 10, 15 towards retirement, 20 years out, now's as good a time as any to start the process of investing.
Thank you, David. That's all our questions. I'll turn it back over to you, Jerome.
Thanks again, David. Really appreciate it. Hopefully you would have addressed everybody's curiosity, I would say. Definitely, if you guys have any questions, any further questions that you perhaps didn't get to ask today, feel free to reach out to us at CFA Society, and we can definitely find the information or provide it to you as best we can. So definitely thank you once again, David. One thing I would say, just as a disclaimer, CFA Society does not endorse any particular investment bank, whether it's RF, CFAL, or Leno, or whomever. Obviously, David is from RF, so he, like you said, he is biased towards RF, but officially CFA, we don't endorse anyone. This is just for information purposes. So with that being said, please join us again next week as we discuss the topic of home ownership. We'll have a very experienced realtor returning again this year. And I know obviously realty and home ownership and service lots, all of that has also been another hot topic of discussion these days. So please join us same time next week. All right, take care, everybody, and enjoy the rest of your evening.
Good night, everybody.
Good night.
Good night.